All right, so welcome to Talk Tickers, the show that cuts through the noise of earnings calls and gets right to the insights that matter. We know you're busy, so we do the heavy lifting, sifting through those dense reports so you don't have to. Today's deep dive, LexinFintech's Q4 2024 earnings call.
And it's a good one. They've been making some interesting moves.
Yeah, let's break down. First things first. The headline numbers. At the end of Q4 2024, LexinFintech had a hefty RMB 110 billion in loans on their books.
That's a considerable loan portfolio.
Definitely. And they facilitated RMB 52 billion in gross merchandise volume during the quarter. That translated to RMB 3.7 billion in revenue.
Not too shabby. What about their profitability?
Right to the bottom line. Their non-GAAP profit was RMB 390 million for Q4.
Just as a reminder for our listeners, non-GAAP profit often excludes certain items like one-time charges to provide a clearer view of the company's core operational performance.
Exactly. It gives you a better sense of their ongoing profitability from their core business.
And what's particularly encouraging is that LexinFintech has shown improvement for several quarters in a row. We're seeing consistent growth in their revenue and, importantly, their profit.
Absolutely. And speaking of profit growth, their net income jumped by a solid 17% compared to the previous quarter, reaching RMB 363 million. Their net income take rate also ticked upwards from 1.09% in Q3 to 1.31% in Q4.
That means a bigger chunk of their loan portfolio is translating to actual profit.
Right. They're getting more efficient at squeezing profits from their lending activities. So overall, a pretty positive picture. Now, let's unpack how they're accomplishing this. Any lending business lives and dies by its risk management, so let's start there.
Absolutely crucial. And LexinFintech emphasized that their new loans throughout Q4 were high quality, which is a good sign.
And they back that up with some data. The early warning signs for risk actually improved between Q3 and Q4. Like their 7-day first payment default rate, basically, how many new borrowers missed their very first payment that dropped by 8%.
Encouraging. And what about the 30-day rate?
That also saw a nice improvement, decreasing by 9%. So the initial performance of their newly issued loans is looking pretty solid.
Great to see. But how's their entire loan portfolio doing, not just the new loans?
Well, the good news continues. Their overall portfolio risk also improved. The day one delinquency ratio, which tells us how many borrowers are late right off the bat, went down by 4% from Q3 to Q4. And even more importantly, the 90-day delinquency ratio, a key indicator of more serious issues, fell by 3% over the same period.
So not only are new loans performing well, it seems they're doing a better job of managing existing borrowers, too.
Right. They're seeing fewer borrowers falling seriously behind on payments.
They attribute these positive trends to their sustained investments in risk management. It's not a quick fix, but a long-term commitment to getting it right.
Right. So what are they actually doing on the risk management front?
Well, they talked about using more third-party data to get a more comprehensive view of their potential borrowers.
Makes sense. More data often leads to better decisions.
Absolutely. And they're developing tailored data systems and risk models specifically for different types of customers.
So recognizing that a one-size-fits-all approach isn't ideal.
Exactly. They also mentioned strengthening their real-time risk identification systems.
So they can spot potential problems faster and react more quickly?
Precisely. But here's where it gets really interesting. They're going all in on AI and big model technology. They mentioned using the DeepSeek model and also developing their own proprietary AI model called Singularity.
So think sophisticated algorithms crunching massive amounts of data to predict which borrowers are most likely to repay their loans.
And it's working. They said their risk identification accuracy improved by a whopping 15% quarter over quarter.
That's a huge leap. It means their models are getting better at predicting who's going to default.
Yes, and importantly, the stability of their models also increased by 10%. Which suggests they're providing more consistent and reliable predictions over time.
So less volatility and more accuracy in their risk assessments.
They also talked about setting up a dedicated risk control laboratory.
Sounds intriguing. What is that exactly?
It's basically a space where they can run small-scale experiments, do A/B testing to compare different strategies, and observe long-term trends in their risk management approaches.
So it's about constantly refining their strategies based on real-world results.
Right. A very data-driven, scientific approach to managing risk.
But it's not just about tech, right? They also talked about actively seeking out high-quality customers.
Definitely. They're expanding their customer acquisition channels and using models that are more focused on overall consumer behavior, not just credit history.
Makes sense. trying to find those borrowers who are not just creditworthy, but also likely to be good long-term customers.
Right. They've also revamped their entire customer lifecycle strategy, looking at every touch point from acquisition to long-term engagement.
Sounds comprehensive.
It is. And these efforts are paying off in terms of user growth. They reported a 23% increase in new active users quarter over quarter, and that's excluding those who came through their intelligent credit platform, or ICP, which we'll get to later.
So they're attracting more users and doing a better job at managing risk. It's a good combination.
They're also focusing on optimizing their credit line decisions, using rapid testing to make sure they're offering the right amount of credit to the right people.
Makes sense. You don't want to give too much credit to someone who might struggle to repay, but you also don't want to offer too little and lose a potential customer.
Exactly. It's a balancing act. And they're also trying to maximize user conversion, meaning they want to make sure that those who are offered credit actually take them up on it.
Right, because pre-approved offers don't mean much if people aren't actually using them. So this more refined approach seems to be working. They highlighted improved profitability in their high-quality customer segments.
And they reported a substantial increase in their high-quality assets, while their prime customer base is steadily growing.
So better risk management is attracting better customers, which is leading to greater profitability.
It's a virtuous cycle. They even talked about developing dedicated scoring models for each of their business lines, products, and different customer groups. This allows them to be much more precise in assessing risk compared to using a generic scoring system.
So a tailored approach for each segment.
Exactly. And they're accounting for those inevitable uncertainties that exist in any model, like when data is missing or there's a lot of noise in the data. They're using algorithms to actually quantify this uncertainty, which helps them gauge how confident they can be in their predictions.
So it's not just about the prediction itself, but also understanding how reliable that prediction is.
Precisely. That leads to more stable outcomes. Their test and learn approach, particularly through their risk control lab, extends to credit line management. They're constantly tweaking and optimizing how much credit they offer based on a borrower's risk profile and the likelihood of them actually using the credit.
So it's all interconnected. The risk assessment, the credit line offered, and the user's likelihood to convert.
Right. It's about finding the sweet spot. They're also doing interesting things on the API side of their business, where other platforms can offer LexinFintech's credit products.
Yeah, that's becoming increasingly popular. So what are they doing differently there?
Well, they've got dedicated models and specific strategies for each stage of the process. They've got different approaches for when someone first comes onto the platform, during transactions, when determining the amount of credit offered, and even for pricing.
So a very granular approach tailored to each step.
Exactly. It shows a sophisticated understanding of risk. They've even gone so far as to differentiate their past due reminder strategies based on the likelihood of a customer actually defaulting.
So someone deemed low risk might get a gentle nudge, while someone with a higher probability of default might get a more urgent message.
Precisely. And for those who repeatedly fall behind on payments, they've launched a dedicated project focused on improving repayment behavior.
How does that work?
Well, they're looking at things like what repayment dates borrowers choose, how often they link their bank cards, and whether they opt into auto debit agreements.
All trying to nudge them towards more consistent repayment.
It's about addressing those specific behaviors that might lead to repeat delinquencies.
Makes sense. It seems like this risk control lab is really the central hub for all these initiatives.
Absolutely. It provides an end-to-end system from designing experiments to evaluating results. They even have intelligent features like traffic segmentation and dynamic sample isolation.
All to make sure their experiments are accurate and reliable.
Right. So really a comprehensive tech-driven approach to managing risk, which, as we said, is fundamental to their success.
It's clear they're taking this very seriously. Now, let's shift gears and talk about operational efficiency, focusing on how they're managing their different business segments.
Sure. So in their core consumer finance business, they're emphasizing deeper engagement with different customer groups. They're tailoring their acquisition and relationship management strategies based on a more nuanced understanding of each segment.
So a move away from the one-size-fits-all approach.
Definitely.
Yeah.
They're recognizing that different types of customers have different needs and require different approaches.
What about their e-commerce business? Any notable developments there?
Oh, definitely. They've completely overhauled their risk management for e-commerce, incorporating real-time monitoring and control at the order level. They've also upgraded their product supply chain. And the result?
Let me guess, rapid profit growth.
Got it. They're seeing strong financial performance in their e-commerce segment thanks to these improvements.
Now, their offline inclusive finance business has always intrigued me. They're focused on reaching small business owners, especially in those lower tier cities, right?
Yeah, that's their sweet spot. And they've really refined their sales management approach, emphasizing one-on-one service.
So more personalized attention for these borrowers.
Exactly. It's about building relationships. And it's working. Over 65% of their lending volume in this segment now comes from fourth and fifth tier cities and below.
That's impressive penetration into those often underserved markets.
And this segment has been profitable for 3 quarters straight, suggesting a sustainable and growing part of their business.
So a real bright spot in their portfolio. What about their overseas operations?
Still early days there, but they're focused on strengthening their risk management and back office support for international markets.
The essentials for any global expansion?
Absolutely. They're also standardizing their processes across different regions and exploring new customer acquisition models.
And the results of these efforts?
Lower acquisition costs and improved stability, though again, it's early days, so we'll have to watch this space.
Definitely worth keeping an eye on. Now let's talk about their intelligent credit platform, or ICP.
It's been a big focus for them. The ICP essentially allows them to collaborate with other financial institutions and leverage their networks and expertise.
Right. So it's a way to expand their reach and potentially reduce their own capital requirements. How's it performing?
It's gaining traction. The ICP share of their total lending volume is increasing, showing that their partners are finding value in this platform.
So it's becoming a more integral part of their business.
Absolutely. Now, all this talk about improved asset quality is having a positive ripple effect on their funding. Because their loans are performing better, they're becoming more attractive to financial institutions. This has allowed them to diversify their funding sources and structures, and as a result, their funding costs for new loans have decreased.
By how much?
They saw a drop of 26 basis points quarter over quarter.
That's significant. Lower funding costs go straight to the bottom line.
Exactly. It's a big boost to profitability.
Right.
And they've also expanded their network of funding partners, now working with 63 different institutions.
So less reliance on any single partner and more flexibility in securing funding.
Precisely. Now, we can't talk about LexinFintech without diving into their tech and innovation initiatives. These are clearly core to their strategy.
Absolutely. And they're putting their money where their mouth is. They spent RMB 151 million on research and development in Q4 alone.
And a big chunk of that is going towards AI. They've successfully implemented leading large-scale AI models like DeepSeek, adapting them for their specific needs.
So they're not just using off-the-shelf solutions, they're customizing them for their own operations.
Exactly. But what's even more impressive is that they've built their own proprietary large AI model, Singularity AI.
And this isn't just some theoretical research project. They've integrated it into their daily operations across various functions, from customer service and collections to coding and data analysis.
Talk about putting AI to work.
Right. They said Singularity is already generating code 860,000 times per month for their developers and has offered 210,000 suggestions for quality improvements just last year.
That's a lot of automated brain power.
Definitely. They estimate that this has boosted their coding efficiency by around 35%.
That's huge. It means they can develop and deploy new features and products much faster and at a lower cost.
And they're using models like DeepSeek to lower their overall computational costs and explore new applications for AI in areas like risk management, operations, and workforce efficiency.
It's clear that AI is deeply embedded in their DNA.
Yeah, it's not just a buzzword for them, it's a core part of their operational strategy. They also highlighted their commitment to consumer rights protection, and even there, they're leveraging AI.
They're using AI to enhance their digital and systematic approach to consumer protection, optimizing those touch points where customers interact with their services.
So using AI to identify and address potential issues or gaps in their offerings.
Right. They're also using it to make their communications clearer and more transparent.
So AI is helping them build trust and provide a better customer experience.
And they're walking the walk when it comes to inclusive finance. They facilitated over RMB 30 billion in loans to small and micro businesses throughout the year.
That's significant. It shows they're committed to supporting those often underserved segments.
Absolutely. All right, let's get back to the financials. We already touched on their top line revenue and profit, but let's look at some of the key rates and costs. Their revenue take rate, which measures how much revenue they generate as a percentage of their loan balance, increased to 6.22%, a jump of 36 basis points from the previous quarter.
That's a healthy increase, but what I find interesting is that they achieved this despite lowering the average interest rate they charge users.
Yeah, their weighted average APR actually decreased by over 100 basis points to 23.88%. So they're becoming more efficient at generating revenue, even while charging less.
That's a good sign. It suggests they're getting better at controlling their costs and attracting those higher quality borrowers who might be less sensitive to small changes in rates.
Right. And speaking of costs, their credit costs, those expenses related to potential loan losses decreased by 5%, or RMB 73 million.
Again, likely a reflection of their improved asset quality. Fewer bad loans mean lower costs.
And as we mentioned earlier, their funding cost for new loans also dropped by 26 basis points.
So multiple factors contributing to their improved profitability.
Exactly. Now let's talk about their tech empowerment services, which include things like their ICP platform and the value-added services they provide to partners. That segment saw a big revenue jump up 57% quarter over quarter.
Wow, that's strong growth.
It now accounts for 16% of their total income, showing that it's becoming a significant revenue driver.
So diversifying away from purely relying on interest income from loans.
Right. And within that segment, loan originations facilitated through the ICP now represent 14% of their total new loan volume. So their partners are increasingly using that platform.
Good sign of adoption.
Their installment e-commerce platform income also grew, up 12% quarter over quarter, and now represents 9% of their total income. So again, diversification of revenue.
They've also managed to reduce their customer acquisition costs, which is always a good thing. Their cost per active user, excluding those coming through the ICP, fell by 21%.
Shows they're getting more efficient at attracting new users.
However, their income from credit facilitation services did see a dip down 9%.
Right. They attributed that to the lower interest rates they're charging on new loans.
So a trade-off there. Lower rates might mean lower immediate revenue from those services, but potentially attract more borrowers and lead to higher volume in the long run.
Exactly. Now, on the expense side, their total operating expenses stayed relatively stable at RMB 1.3 billion.
So no major cost overruns despite their growth and investments in new initiatives.
Right. Good cost management. And as a result of all these factors, their net profit margin, that is, their profit as a percentage of total revenue, increased from 8.5% to a very respectable 9.9%.
That's a significant improvement. Clearly, their strategic focus on asset quality, efficiency, and diversification is paying off.
Agreed. Let's take a quick look at their balance sheet. Their cash position at year-end was about RMB 4.1 billion, and their shareholder equity stood at around RMB 10.7 billion.
Healthy numbers. And their provision coverage ratio, which indicates how well they're prepared to cover potential loan losses, was a solid 255%.
So they've got a good cushion to absorb any future credit risks.
Yeah, what about their dividend?
They announced a cash dividend of USD 0.11 per ADS for the second half of 2024. That's roughly 20% of their net profit for that period.
Not bad. And they plan to up their dividend payout ratio to 25% starting in January 2025.
So signaling a commitment to returning more value to shareholders.
All right, let's wrap up with their outlook for the rest of 2025.
Well, they're sticking to their prudent operating strategy with a focus on risk management and optimizing their asset structure.
So no sudden shifts in direction.
Right. Steady as she goes. They express confidence in achieving substantial profit growth throughout 2025. That's good to hear. Any specifics on how they plan to achieve this?
They talked about refining their credit lines and pricing to offer more differentiated products. They also mentioned continuing to improve their operational systems. And they're looking to proactively expand their business into new areas to drive further growth.
So a multi-pronged approach. What about their near-term expectations?
They expect their gross merchandise volume for Q1 2025 to be flat compared to Q4 2024, which they attribute to the Chinese New Year seasonality.
Makes sense. Things tend to slow down a bit during that period.
For the full year 2025, they're projecting GMV to be either flat or to see single-digit percentage growth year on year, depending on how the broader economy performs.
So a bit cautious on the top-line growth front.
But despite that potentially modest GMV growth, they're still forecasting a significant jump in their net profit for the year.
Interesting. How do they plan to achieve that?
They expect to see profit margin expansion thanks to their ongoing asset quality improvements and the results of their business transformation efforts. So focusing on squeezing more profit out of every dollar of revenue.
Exactly. They also plan to invest more in customer acquisition in 2025 with a focus on improving the efficiency of those investments.
So trying to get more bang for their buck when it comes to acquiring new users.
Right. They're also aiming to enhance profitability, maintain stable growth, and prioritize asset quality.
Those are all good things.
Absolutely. They'll continue upgrading their risk management systems, aiming for consistent reductions in those key risk indicators, and they're targeting stable scale growth by improving customer acquisition, strengthening partnerships, and growing their offline inclusive finance and e-commerce businesses.
Sounds like a well-rounded plan.
And lastly, they're open to further increasing their dividend payout ratio in the future if their profits continue to grow.
So a potential bonus for investors down the line.
Exactly. They're aligning their shareholder returns with their profitability.
All right, so stepping back and looking at this earnings call from an investor's perspective, what are the key takeaways?
Well, the continued improvement in their asset quality is a big one. It speaks volumes about their risk management capabilities and their focus on sustainable growth. And that directly translates into higher profitability, which investors always love to see.
Right. The fact that they're attracting and growing their base of high-quality customers also bodes well for their long-term prospects. It suggests they're building a more resilient business that's less vulnerable to economic shocks.
Definitely. And their embrace of AI is another major takeaway. Their investments in technology, particularly their in-house developed Singularity AI model, could give them a significant edge over competitors who are slower to adapt.
It's clear that AI is more than just a buzzword for them. It's a core part of their operational strategy, and they're already seeing tangible benefits from these investments.
The success of their tech empowerment services, especially the ICP platform, is also noteworthy. It shows they're diversifying their revenue streams and moving towards a potentially more capital-light business model.
And the increased dividend payout ratio is a nice signal to shareholders that they're committed to sharing their success.
Absolutely. So for investors who are considering digging deeper into LexinFintech, what should they be watching in the coming quarters?
Well, keeping a close eye on those key risk indicators is crucial. We're talking about the 90-day delinquency ratio, the 30-day first payment default rate on new loans, that 7-day first payment default rate on new loans, and the day one delinquency ratio for their entire portfolio. These will tell us if they're continuing to make progress on the asset quality front.
Agreed. Those are the numbers to watch. Also, pay close attention to their net profit margin. Continued growth, there will be a key indicator that their strategic initiatives are bearing fruit.
And don't forget about their Q1 GMV guidance, which is flat due to the Chinese New Year seasonality. It's important to keep that in mind when evaluating their short-term performance.
Right. Don't be alarmed if they don't see massive top-line growth in the first quarter.
All right, it's time for our This Is Not Financial Advice segment, where we throw out some potentially outrageous but plausible trade ideas based on what we've learned. But as always, remember, this is just for fun and definitely not investment recommendations.
All right, let's get speculative. So LexinFintech is making big bets on AI, and they're seeing some impressive results, particularly with their in-house Singularity AI model, which they say is boosting their coding efficiency significantly.
Right. And they're not the only ones. The race for AI talent is heating up globally.
Exactly. And companies with demonstrable AI capabilities are often commanding premium valuations.
So where's the outrageous trade idea?
Okay, how about this? Go long on LexinFintech. But here's the twist pair, that with a short position in a broad index fund that includes a lot of traditional financial institutions, those that might be slower to adopt and fully integrate AI into their operations. The thinking here is that if LexinFintech's AI advantage truly translates into superior operational efficiency and profitability, they could potentially outperform the broader market, especially compared to those slower-moving incumbents.
So a bet on the disruptor over the disrupted.
Exactly. Of course, this is a high-risk, high-reward idea that hinges on LexinFintech continuing to execute on their AI strategy. But it's an interesting thought experiment.
Absolutely. But once again, this is purely hypothetical, not financial advice. Do your own thorough research before making any investment decisions.
Always.
And that wraps up our deep dive into LexinFintech's Q4 2024 earnings call. We covered a lot of ground today, exploring their focus on asset quality, the impact of their tech investments, and their outlook for the year ahead.
We hope you found this breakdown helpful.
For the full picture, always refer to the original earnings call transcript and any related investor materials.
Always good to go straight to the source.
But we want to hear from you. What stood out to you in this deep dive? What are your thoughts on LexinFintech's AI strategy, their expansion into lower-tier cities, or anything else that caught your attention? We're always eager to hear your perspective.
Join the conversation.
And just a final reminder, the trade idea we discussed was purely for illustrative purposes. It's not financial advice. Always do your own research before making any investment decisions.
Always a good reminder.
Thanks for joining us today on Talk Tickers.
Anytime.
For another insightful exploration of the world of earnings calls,